stock market crashes, they don't occur as often as people think. So there was some research that we've done recently, and I've talked about how markets behave at all-time highs. How likely are they to crash 10% or more from an all-time high? And it's actually less likely than the market carrying on to new all-time highs. So go back and listen to that podcast episode. It was the last couple of shows ago, I think. But what about the lessons you can learn from previous stock market crashes? Now, when I was away, I was supposed to be relaxing. I'm not meant to be doing money stuff, but it's very hard not to when you do it all the time and you sort of eat, sleep, live, breathe money and trying to teach people. And I was reading some research actually about the lessons of stock market crashes. And now there's some research done in association with Bloomberg that related to 68 countries. So we're talking developed world and we're talking emerging markets. And they looked at 125 crashes in stock markets of 40% or more across all of these markets. And they had a bizarre way of summing up the amount of years that covered. Rather than just saying it covered 50, 100 years, they said it covered 1,878 years.
Because they totaled it all up amongst all of them.
Yeah, which I don't know why, but I find that not only confusing, but slightly disingenuous. But anyway, the point was it was a very exhaustive piece of research. So you might think, how often do crashes happen? So the frequency of drawdowns or crashes in stock markets in developed worlds, they happen about 10% or less every 2 years. So something like between 10% and 20% happens every 2.8 years. In emerging markets, it happens slightly more frequently at 1.9 years. So you might think that emerging market crashes or corrections of 10% or more happen far more frequently than they do. They actually happen more frequently in developed world markets, but not crazily so. So what about bear markets? So when the market falls 20%. Now they happen every 5.4 years in developed markets and every 3.9 years in emerging markets. So it's much more frequent. And if you look at 30% falls, then they don't actually occur as often as people think. That's what people worry about. It's 9.3 years in developed world markets. That means almost once a decade. So a 30% fall in stock markets is a once in a decade event. In emerging markets, it's 6.7 years, a bit more frequent. And a major correction, so you get a 40% fall, only occurs once in every 15 years in developed world markets and 10.7 years in emerging markets. So it's a decade event in emerging markets. So that is not as often as people think. So we have a lot of people worrying at the moment that we're going to get another 40% fall, something like a dot-com bubble bursting, that kind of event, or a financial crisis event where after that financial crisis markets collapse. But the evidence shows they don't happen as frequently as people think. So we fear these things, but they don't occur as often as you need to worry about. Now, of course, they do occur. But what about the recovery? Because the fact that they do occur, that's life. We have the ups and downs, and then we're going to have these periodic corrections. So if we look at the recovery of these things, because that's what's important, the recovery time after up to 30% correction, so 30% or less, is typically 1.2 years in developed markets and 0.8 years in emerging markets. So we have this case where the corrections are more frequent in emerging markets, but you recover from them more quickly, and that's partly because of the volatility, the ups and downs you see in emerging markets. Now, that shows that the recovery is quite quick, but it does obviously depend on the severity of the drawdown. Where it gets a little bit more worrying is if the drawdown is 30% or more, then the recovery time suddenly extends much more. So we're talking typically at least 6 years in a developed market. And if you're in emerging markets, it goes up to 5 years. It's still that little bit less.
So it's gone from 1.2 year recovery to like 6 years.
Yeah.
Like 4 or 5 times the recovery time.
Yeah, and if you look at some markets, so the Japanese market, when it collapsed in the late 80s, they're still trying to recover from that. So this is why buy and hold strategies, they say work over the longer term and they will beat other strategies. This is why it's not always true, because it depends when you bought.
Yeah.
So if you buy in and you bought it at the top, put all your money in, and then the market collapsed, then you could be waiting 6 years just to get to the break-even point again. And that's why corrections and crashes and bear markets, while they're obviously, you don't want them to happen, they don't happen as often as people think, but they're not the things you really need to worry about. What you really need to worry about are the 30% falls, the next financial crisis type of stuff. So they are the ones that really damage your wealth. And for investors, that's the one where their wealth is eroded and it takes far longer for them to recover. And if they're nearing retirement and that happens, that's when it can suddenly really hit them if they start to try and draw down on it, which is why you need to start preparing when you get towards retirement. We did a podcast on that. Somebody asked me what sort of asset mix you should have. That's why you have this kind of lifestyling idea where you start to move from risky stuff to more safer or lower risk investments.
And that's to do with your age and subtracting stuff. We've covered that on the podcast before, haven't we?
Yeah, and it's just about trying to you focus more on capital preservation than you do on the growth aspect of it. So instead of trying to shoot the lights out, you're just trying to keep the lights on. And the interesting thing is, for investors, I've been reading a book as well while I was on holiday. I've been doing a lot of reading. And one of the books I was reading is based on investing. I'm thinking of reading loads of investment books and money books in the next year as quickly as I can to sort of pull together some of the best bits, partly for the podcast. I mean, I read a lot anyway, but trying to condense a lot of that down. But one of the books that I was reading made a couple of good points about the psychology of investing. There was some research that was done to show, firstly, that people in bull markets tend to become more aggressive and they tend to take on more risk. But when markets start to fall, they tend to then put their foot on the pedal and take less risk. And a lot of it's down to psychology, but some of it is physiology as well. It's about the way your body reacts to fear, and it starts to deliberately make you more cautious. It's because if you want to survive in the wild, if something happens, then certain chemicals are released in your body that make you take more or less risk. And that's why it makes us bad investors. So the point is, when you get these crashes that happen that may be short-term, smaller ones, overreacting to them is human nature, and you need to try and stop doing that. So you need to have a process, whatever that is, whether it's 80-20 investor, whether it's just the fact you've got to sit on your hands, stop looking at your portfolio, then you need a process to try and cope with that. But the other interesting point is that depending on when you invest, when you start investing, it has a disproportionate impact on your behaviour, your perception of risk. And this is true of everything in life. So your memories when you were young have a bigger impact on you as an adult than maybe some of your more recent ones. It's just the way when you learn something for the first time or you encounter something for the first time, then whatever happens has a disproportionate impact on how you'll behave in the future.
That's why I'm a negative Watford fan, because the first game I went to, they lost 3-0.
That is a perfect example of why being a Watford fan, or Andy, his view is very pessimistic about the prospects of Watford. But in investing terms, that means that if people enter a market when it's flying, they will start to probably take on more risk and be more bullish, and it will impact how they behave in the future. Equally, if you invest during a time when markets crash, then you may become completely fearful of all types of investing and therefore bail out before it has time to recover. So that's about being human. So the message of this part of the podcast is that these corrections occur. They don't occur as frequently as you would expect, but neither can you predict when they will occur. So there's no point trying to predict when the next black swan event will occur, because you won't get it right. But you want to try and avoid them if you can, because they are the things that damage your wealth the most. But if you can't predict them, and you shouldn't, then what does that mean? And the answer is you should just prepare for them. So you should try and prepare your portfolio that can be diversifying. It doesn't mean just diversifying in, say, equities, just going, right, I'm going to have American, I'm going to have European. Just geographically diversifying within one asset class won't necessarily protect you, because in these kind of Armageddon events, they are global, so everything falls. So it isn't that necessarily the America will hold up, everything's going to sink. So it will be about holding different types of assets. That's why you diversify. But the other thing to bear in mind is that I'm a big fan of stress testing portfolios, and we talked about that recently on the podcast. Now, 80-20 investor members will know that I have just updated the stress test tool that we produce on there. And what it is, there are a bunch of scenarios. So I've particularly picked out Brexit, an escalation in the US-China trade war, currency wars. But there are a number of scenarios that could happen. And I've gone back and looked at periods of time in the past where those risks have flared up and looked at how things have behaved. So therefore, any fund, I can give it a score based on like stress testing it in the scenario to see how it might perform. And by doing that, you can then prepare a portfolio in case of an Armageddon event or a black swan. It won't stop a black swan event hitting your portfolio, because of course when the market falls, you're going to fall as well, but it may just mean that you will fall less. Now, to encapsulate that and to show what I mean, I did that back in May. I'm very conscious of this, given where we are with markets and what's going on. And my portfolio in the last month in the month of August is been doing really well. Now the market on average, so the mixed sector, which is 40% equity to 85% equity, that sector is quite punchy for comparison to me. I like to give myself tough benchmarks. I don't have 80% equity, but what's happened is that the average return in August has been minus 2.62%. For the average fund in that sector. That's just the average. You can imagine quite the range has gone down. And out of the 223 funds in that sector, only 4 made a profit. All the others lost money. Now, my portfolio, which would be, again, is comparable to those kind of funds, has made a profit in August. And part of that reason it's managed to do that is because there was a focus on stress testing what could happen with the trade war. It was one of the ones I carried out at the time. And of course, in August, if you follow midweek markets, we looked very much like May, where Trump escalated the trade war. Now, of course, that can reverse. And so, therefore, I'm not sitting there counting my chickens and everything and gloating about it, because markets can change and conditions change. But it's just to highlight that that's why you do it. So it's about preparing. And there aren't many tools out there that can help you do it. I made one deliberately on 80/20 Investor because of that. So that's the message, Andy. Prepare a portfolio in case if you're worried about those 40% corrections. But of course, time is the best healer. And that's for lots of things in life, because of course, like we said, the recoveries are 6 years. You just need to make sure your time frame is extended, and you extend your time frame. You don't necessarily have to sit in the things that are going down. You can review your portfolio, but if you increase your time frame, then the price you got in a market at has less and less impact on your eventual return.